So, Tyler, do you blame fiscal 1.9, I don't know, whatever we spend on the Rescue Act? Do you blame that? Do you blame an over-accommodative Fed? Where do you place? Or, I mean, there's reopening, there's the pandemic, there's supply chain, there's a lot of blame to go around. Where do you put the blame?
There's a lot of blame to go around, and Austin's right to note that in the euro area, food and energy have been a big deal in the past couple of months. But in terms of the underlying inflationary pressure, the real divergence between the United States and the euro area occurred in March 2021. They had been running even. If you look at a harmonized index of consumer price inflation, actually inflation in the United States was a little bit below the euro area through February 2021. It was in March 2021 that the divergence just exploded. And I think that's because we had a demand stimulus equal to about 10% of the U.S. economy. And demand for goods just took off in March 2021, growing at an annualized pace of 240%. That's a lot of demand to be pouring on a supply side of the U.S. economy that was still recovering.
Maybe it was necessary, Austin, with given what we were going through, or no?
Well, look, rather than argue about what happened more than a year ago, and emphasizing that if you look at the producer price side of inflation, it's up everywhere in the world more than on the consumer side, and it's up more in Europe and Asia than in the U.S. Instead, let's say if your fear was demand driven from stimulus, then you should be fearing deflation this year, because if you look at the GDP numbers, we now roll off the stimulus and it cut 3 percentage points off GDP growth. I don't think that demand stimulus can explain the continuation of inflation. I think for that, you've got to look at the supply side.
It's called the trade deficit. It's called the trade deficit. We want imports so badly. That spells demand. D-E-M-A-N-D, import demand.
Also, look, I mean, inflations are a function of inflation expectations and cost push and demand pull factors. And inflation expectations have now risen. Inflation expectations have now risen.
Stephanie,
they have not risen to 8%.
Before Rick got in, this was my next line to you. Stephanie, I want to get to you, but I really want to let Rick pile on with Austin if possible. So maybe we'll get. I'm kidding, Austin, but we'll get back. Sort of. We'll get back.
You're not kidding.
We'll get back to that. Stephanie, what do you do? I mean, would you change what you said earlier for how to position yourself now?
No. Look, the last couple of days, Mike said it best, I think, that there was chatter that we were going to say, oh, this is the peak. The number was going to be so much lower than expected, and it was going to be a surprise, and then stocks could rally, and that's actually not happening. I mean, no matter what, as I said earlier, that inflation is high. Even if this number came in better, it's high, and it's going to stay high for a very long time. And I'm more worried about the wage side and the rent side of inflation, because I think that's much stickier. And we've seen a lot of various different data points that suggest that we are seeing a lot of inflation on the wage side, right? So wages are up 5.5%. Unit labor costs are up 7.3%. These are year over years. Employment cost index of 4.5%. These are huge, huge, huge numbers. And my point about mentioning this is that I don't think the Fed can really do anything unless they put us into a big recession. That's possible, to get this inflation down. And on the rent side, I mean, the Dallas Fed, they're talking about next year seeing rents up about 6.5%. I think you're going to see a lot higher because we know rents follow housing, and housing is up huge in terms of prices. And so, this is a really challenging market. We've seen multiple contraction. We've talked about that all year long. We went from 21.6 times on the S&P 500. We're now at 17.3 times. We could go back to the average of 16 times or even overshoot for that matter. So that's on the downside. And the fact of the matter is we have all these uncertainties, and unless you resolve one or all of these uncertainties, which we're not in the near term, you're not going to see multiple expansion. So therefore, you're in a trading range. Okay. I would still look for quality companies, free cash flow companies, good balance sheets. A lot of stocks are on sale, but you don't want to go all in. So that's kind of what I've been doing. I've been nibbling on the margin, definitely on the services side of the ledger, but also just quality and some growth names that I think are just way oversold.